So thank you very much, and we can then move forward to the training proper. In terms of agenda, this is what we set out to cover. We will start with an overview of the Nigerian tax laws, just a brief introduction. Then we'll go into the Nigerian Tax Administration Act. We'll talk about the Joint Revenue Board Act, the Nigerian Tax Act itself, then the Nigerian Revenue Service Act. What we try to do, and you will observe as we go along the training, is to talk around what we think is very important for most of us to be aware, or what is applicable to most of us as clients. So we've tried to streamline as much as possible so that we focus the training on the very important thing. And that's the only way we can get that done in the projected time of 6 hours. In terms of learning objective, we expect that at the end of the exercise, but tomorrow, participants will have an understanding of what constitutes the Tax Act, the new Nigerian tax laws, what exactly. You have an understanding of the timeline, will be able to understand the key requirements of the new Nigerian tax laws. And from this meeting, all of us will begin to think about the likely impacts of the law on our business. So we'll start with talking about the overview, and that's will be the first section, which I will take. Just looking around, quick overview of what is this Nigerian tax laws 2015 all about. Well, the law has 4 components. So when we talk about the new Nigerian tax law 2015 and 2025, there are 4 components in that law. We have the Nigerian Tax Act, we have the Nigerian Tax Administration Act, we have the Nigerian Revenue Service Act, and the Joint Revenue Board Act. Those are the 4 acts that makes up the Nigerian tax law 2025. So anytime we talk about the new tax laws, we are talking about these 4 acts. And each of them has specific items, specific issues it deals with. So when you talk about the Tax Act, that is that consolidates and repealed most of the tax acts that we are familiar with. The company income tax, the personal income tax, the VAT, the capital gains, all of those things have been consolidated into the Nigerian Tax Act. And it deals with the law that governs the tax itself. What kind of tax do you pay? How do you calculate it? How do you file it? All of those are the taxes you need to pay. How do you determine it? Or what transaction do you pay it? All of those is what you have in the Nigerian Tax Act. Whereas when you talk about the Tax Administration Act, the Nigerian Tax Administration Act, that talks about how you manage, how you collect and administer the tax itself. How do we get this tax? Remember, the Tax Act talks about the tax you need to pay and how you determine what you need to pay. Whereas the Administration Act talks about how do I collect it and how do I manage it, how do I administer it. That's what the Tax Act, the Tax Administration Act is focused on. And then the Nigerian Revenue Service Act establishes what we call the Nigerian Revenue Service, which has replaced the Federal Inland Revenue Service. We're all familiar with Federal Inland Revenue Service, but that has been replaced by Nigerian Revenue Service now. So no more FRS, rather what we have is NRS. I mean, that's what is happening globally. It's a global trend now. People are changing the revenue collecting agent to be an umbrella body, trying to pull all their revenue collecting agencies into one single agent, which is the same thing Nigeria has tried to do. Then the last one is the Joint Revenue Board Act, which creates the statutory body for the federal government, that's Nigerian Revenue Service, and the State Internal Revenue Service, plus the local government. So it creates that body, bringing together all these 3 tiers of government to discuss the issues of taxes and revenue collection. So that has been created by the Act. And also it creates what we call the Tax Ombudsman. So part of the creation of this law is to create a special body to help or to mediate tax matter between the tax authority and the taxpayer. That ombudsman was created for that purpose. So you could approach them when there are disputes, when there are issues, to mediate between the tax authority and the taxpayer. And then when we go into the act, we'll talk more about that. Then we have Joint Tax Appeal Tribunal. This also law created the Joint Tax Appeal Tribunal. So those are the 4 acts that we have under the Nigerian tax law. Overall, if you look at it, what is the focus of the law? 4 things. 1, consolidation, bringing together all the multiple laws, over 50 of them that we have, into just 4 documents. So it's straightforward, and all of us can easily go through it and understand what are the requirements of the Nigerian tax laws. What do I need to do when it comes to levies and taxation in Nigeria? So it has consolidated all of those things together. The new law is more progressive. The more you earn, the more you pay. So it's focused on the progressive tax system, and a lot of simplicity has been brought in. Simplicity are relevant to today's reality, today's business practices, and then a lot of things in the law is also a lot of things really poor. You don't have undue tax burden. You don't bear undue tax burden. But in all of this, there will be so much agitation. Yes, we are not here to talk about the agitation. We are here to discuss the content. But some of us will have seen some of those ranting and banters on social media. But I will always say tax is a very, very specialized subject. And when it's being discussed, it needs to be discussed by people that really understand it. It's not just social commentary. It's a deep technical subject that has to be discussed by experts. But what are really the reason why maybe we have some of those agitations? I would say, 1, inadequate knowledge. I think a couple of people discussing this subject do actually do not understand the concept of tax. They are discussing it like news headline. And tax is a deep subject that requires a lot of technology. And I know that a lot of us, even in this show, you're a chartered accountant, so you understand the technicality and the depth of what it involves when the issue of tax is being discussed. And also some level of poor tax compliance, I think, is also one of the reasons why so much agitation. Because if you look at the law overall, 90% of the content of that law is not really, they are not new. And most of the key changes that you have in that law is centers around helping government to be able to collect taxes, not even putting additional burden on taxpayer. Rather, it's around how will government be able to collect more, not necessarily how people that are already paying the correct amount pay more. It's not geared towards people that have been paying already pay more. It's rather centers around people that are not paying. How do we get them to pay? And I think maybe this is one of the reasons why we have so much agitations, because as many people that know that they're supposed to be paying and have not been paying, they are agitated, because under this new regime, it's likely that government will be able to identify such individuals. There is complexity of the subjects, which so many people have different views. We've even now seen the battles being taken even to the big boys in the market, to the big firms, battling even on the content, because it's law, and law can be very sensitive. You say it's supposed to be worse, you know it is, and then the interpretations begins to differ. And again, we've seen even the diverse version, the House of Rep, saying what was published or what was signed into the law was not what they passed. All of these are part of what is causing so much agitation. And there is a fear of undue burden. There is also fear in certain quarter. However, the law is the law today. And as law-obeying people, we need to begin to comply. And that's the reality. And that's why the two firms said that let's spend some time early this year to talk to our clients, to discuss some of the key requirements of this law, so that we also can get prepared. If there are things you need to do, if there are transactions you need to structure, we can start having that. Maybe one or two of us, even after the sections, you may want to have side charts to talk around some of these issues. will be open and available to do that. Okay, so we'll move forward to start with the Act, and we'll be starting with the Nigerian Tax Administration Act. The Nigerian Tax Administration Act, which became effective 1st January 2026. So the law is, this act is not effective, and we will all be expected to start complying with it. And so let's go through some of the key requirements. In Chapter 1, it deals with the jurisdiction and registration of tax authority. A couple of those things we'll be discussing again are not new to you. You've heard it before under the previous law. But there are also one or two amendments which, as we go along, we will try to emphasize those amendments so that we can pick it up. So Chapter 1 is on jurisdiction and registration of tax authority, and it's deals with the structure for the administration of tax in Nigeria, recognizing that there are two parties in the tax system, the taxpayer and the tax authority. That is clearly identified by the law, and it also specifies the responsibility of the Nigerian Revenue Service, the new body, which replaced the old Federal Inland Revenue Service. And the NRS, just like FRS, again, is responsible for collecting the listed taxes. So in terms of the taxes they collect, essentially it's the same. They will continue to collect the federal taxes, which are the company taxes. All taxes payable by the company will be collected by Nigerian Revenue Service. Police, military personnel, their taxes will be collected by NRS. Non-resident Nigeria, we will talk about non-residents in subsequent slide. Non-residents that are earning income in Nigeria will also pay to the Nigerian Revenue Service. Specialized taxes like development levy. Development levy is new, and we'll talk more about it. It replaced our old educational trust fund, NASEMA fee, police levy. All of those has been replaced by development levy. We'll talk more about it. They will collect VAT. They will also collect economic development tax. The economic development tax is what replaces your pioneer status tax. All the pioneer status tax, pioneer status incentive has been replaced by the economic development tax. They will also collect stamp duties. Stamp duties will be collected by the Nigerian Revenue Service. The other extra that is worth noting is also that even your duties, your custom duties and co, even while they might not be the agent collecting it directly, they will have access to the data. So the whole essence is the revenue, other revenue collecting agencies, the custom and co, will now be using their own technology, using their own process to drive their collection. What government wants to achieve is to have one single view into all the revenue that has been collected, and also identify people, like people that are importing goods. You are able to know them and say, okay, so Mr. A has imported this level of goods to Nigeria. So where is his revenue? Because he has sold those goods, so that there will be some level of collaboration, just like what Lagos State government does now. That when you pay land charges, they have it in your e-tag, so they can ask you questions around it when you are coming to do your tax clearance, and say this is the level of tax you are paying, but see the kind of land charges you are paying. It doesn't match. So they want to use this centralized thing to be able to have one single point of view to all the Nigerian activities. The state or the Federal Capital Authority will continue to collect the individual taxes. They will collect the individual taxes, the personal income tax, capital gains by individual. If you have capital gains on the sales of your assets, that will be collected by the state. Stamp duties that is due by individual. If you have stamp duties payable to individuals, that will be collected by states. Anything that has to do with individuals will be collected by states. And also their internal revenue service, if you don't have. And also to leverage technology as much as possible. In fact, part of the provision in the law is the fact that the state can even decide to outsource their collection to NRS to help them be collecting it. I believe what we are doing is that the most efficient tax collector in Nigeria today is the Federal Tax Collecting Agency, the Nigerian Revenue Service, formerly FRS. They are the most efficient, more efficient than states. So technically, these two allocation of what the taxes they collect is like what it used to be. Let's talk about registration of taxpayer. Taxable person must register and obtain tax ID. You are expected to register once you are a taxable person, individual or corporate. You must register and collect your taxpayer ID. There are other long definition of long processes that are stated in the Act. You must register and obtain it. If they discover that you've not registered, they can automatically issue one for you. You must not have two taxpayer ID. You only have one, so you cannot have two taxpayer ID as a taxpayer or as a company. And then the last point here is non-resident persons supplying goods or services must register and obtain tax ID. Any non-resident person that is supplying goods or services to Nigeria must also register with the Nigeria Revenue Service and obtain a tax ID. This provision is not new. It was so, but I know that a lot of companies and a lot of us have not implemented it. If you have non-resident people, if you are importing goods to Nigeria, the rule now today is that such company, non-resident supplier, should register and obtain tax ID. Please let's note it. It can impact on some of us. Under the previous dispensation, there was a threshold defined, 25 million. If the supply is less than 25 million, it was not required. We don't know what will be the final modification. Maybe they will issue a circular to define that threshold. That has not been done yet. But the law says you must register and obtain tax ID. Use of tax ID. It is not mandatory that banks, insurance, stockbroking, or other financial services should ensure that every taxable person provides tax ID. And for those of us that were asset managers, we are stockbroking firm, we are insurance company, or you run a microfinance bank, it is now mandatory that all your customers should produce a tax ID, all your taxable person. This is one of the areas that one of the difference is taking them up, because is there really any non-taxable person that has a bank account in Nigeria? You don't make income, or possibly you say you are not that age, maybe. But once you are considered that you are taxable, you make income, you are expected to provide your tax ID to all of these institutions. And if you are any of these institutions, you are expected to collect tax ID from your customers. I think this is one of the areas that government want to use to track flow of funds and be able to identify taxpayers. If you have money in any of these institutions and you are claiming that you are not making enough income, they can easily use your investment to track how much income you are able to generate. Again, this is also in the old law, just being emphasized. Anytime there is change of your business name, if you are changing your company's name, you are changing the phone number, you are changing your directors that owns more than 5%, you are having a change of directors that owner owns more than 5%, the new directors now own more than 5%, you need to inform NRS of that fact. If there is a change of business structure of ownership, you need to also inform them. And if you are a change of location, you need to inform NRS. I know that a couple of us clients may not even have informed NRS when some of these things happens. It's always good, and that's the law, even while they not be enforcing it to the latter themselves. Cessation and suspension of tax ID. Clients, if you have a business that you know that for now, this business you are no longer running it, which happens, or this business is not doing well, you are not sure whether you want to close the company or not, you can approach the NRS and request that they should please suspend your business or tax promas temporarily. You write to them, they will ask you one or two things, they will ask for evidence, maybe to show that you have not been making income. They will suspend you on tax promas. So all those your regular filing will be put on hold. You will not need to be worried about that every month. The system will show that your business has been suspended, and you can deregister completely if you feel you've ceased operation. At the point that the business ceases operation, you can deregister completely. For you to do that, they will request that you show evidence that the business has been deregistered, that the business has been deregistered at Corporate Affairs Commission. That is the only basis they will deregister you as a company from their system. That is also good because some of us have clients that, or some of us have not been running our business for a while. Please, you can consider deregistering yourself from FRS portal.
Good morning, everyone, and thanks for making it a day with us, being part of this today. And thank you very much, Abiola, for introduction and the part that you have been able to lay the foundation, which myself and Abiola will be building on. And I know you will also be coming in at one time or the other in the course of this presentation. So I'm supposed to be talking on returns, supposed to be talking on returns, assessment, and payment. And the key thing here is that first we need to establish who is a taxable and what is a taxable item. When I say what is a taxable item, I'm talking of us identifying what an income is. That is, who has income, and whether it is an individual or business. How is the income earned, and what makes that income object of taxation? So if you look at the Act, the Act talks about the fact that any individual or organization that makes profit on any company or enterprise, make profit on the or income of an individual or family, or income arising or accruing due to a trustee or an estate, are supposed to be. So that's what this is talking about. So in this slide, you will see that instead you are supposed to be taxed, so you need to do what we call assessment. That self-assessment is that you identify, okay, you have made money, how much tax am I supposed to pay on it? Pay it without them asking you, without the tax authority asking you, you pay it. And at the end of the period, you file and notify the tax authority. These are the incomes I earn in the course of the year, and these are my taxes that I have paid. And with that, the tax authority will be okay with you, except for after some time that they will subject the individual or the organization to what we call audit, to check whether what you have assessed, as in the income you have reported, tallies with the revenue, with the taxes that you have paid. So all of us, companies, individual employers and employee, has to do filing we have to assess ourselves and file with the relevant tax authority. And one of the things that this law also introduces the fact that you can then do what we call electronic filing, which at some times at the state level, in some particular states, I will not be able to get that done. But with this new tax law, you'll be able to do what we call electronic tax filing. So the tax authority may accept or reject your filing. Why? If you are filed, you declare your revenue, or you under-declare your revenue. With the new system, it's easier for the tax authority to actually tie all, because of your tax ID, and the fact that your tax ID is with the bank, is with your investment, is with the managers of your personal estate. So the tax authority will be able to know what you are earning. And from that, they will be able to see whether what you have paid as tax adequate for the income that you have earned in the course. So that's why that tax ID is very, very important. And one of the reasons why it has generated a lot of controversy is because many of Nigerians, many of us are not reporting our revenue adequately. Sometimes we just feel that, okay, that one will not be taxable, not minding what the position of the law is. So the essence of this law is to bring more people into the tax bracket, the net, and get more revenue that used to escape due to one excuse or the other to come into the coffers of government. So that's what this trying to achieve. So every company is expected to file a self-assessment return with the service in the form at least once a year, and such return shall contain one, a duly completed self-assessment form as may be prescribed by the service. This is not really new in the sense that companies on yearly basis file through your tax promax your return in terms of, oh, this is our account, and then you self-assess yourself, then you pay the tax. So now the audited financial statement will be uploaded, and when it is uploaded, it helps to determine what capital allowance should be entitled to, and you check back with what you have also computed in yourself using your own system, and then you pay the tax. And when you pay the tax, the evidence will be granted, given unto you. The computation of the effective tax rate or the additional tax payable, where applicable, I think there is a specific area for companies that have revenue more than 30 billion. They are required, or it is expected, that they must pay their effective tax. That is the tax they will to be at least 15% of the profit. So in situations where the tax authority realizes that what you have paid is less, the tax authority has the power to assess you to additional taxes. So there's also an attestation. Every information you have provided to the tax authority, you need to confirm by putting your signature to it as the provider of that information, or the person duly have authority, as the due authority to represent that company or the. So now, the area that have been generating a lot of issues, another area that have been generating a lot of issues is the tax return by non-resident company. We know that prior to now, a non-resident company and you are doing transactions in Nigeria, is this final tax that now starts 2020 top out, that you just pay withholding tax, final tax of revenue you have in this country. And as at that time, they were not required by law to have a base or to have a tax identification number. But now, this new law requires that for non-resident company that earns revenue from this country are required to have a tax identification number. So, and where a non-resident company derives profit from or is taxable in Nigeria, such company is expected to submit a return for the relevant year of assessment. And in that return, what it's supposed to have there is the company's full audited financial statement and the financial statement of the Nigerian operations attested by an individual, independent, qualified, or certified. So, tax computation schedule based on the profit that is attributable to the Nigerian operation will be properly stated, and that is what the tax that the non-resident company will pay. So another thing that is required is that you must provide a true and correct statement in writing that contains the proof that shows the profit from each and every source in Nigeria. So if you are a foreign company that renders maybe in oil and gas, render services, drilling services to different Nigerian companies, then you are required to those revenue that you earn from those companies, to report them. It's everything correctly. So another thing is that they will duly feel, they will complete an income tax self-assessment form, and they will use, that to meet the revenue that they earn in Nigeria, so that they pay the requisite and the correct that they are supposed to pay. The effective tax rate and additional tax payable, where it is applicable, should reflect the actual revenue that this organization have been able to earn in Nigeria. Now, another thing that this particular new tax law brought to registration of taxes, it is required that every company should designate a representative or a tax who shall attend to all its tax matters. This is not new. Even prior to this tax law, we know that we have tax consultants that represent organizations with regards to their tax matter. But now, no longer tax consultant. We are calling them now tax. And such a person or a representative is, the representative might be a paid agent. So agent shall be an accredited tax agent. What I mean by paid agent is that the person is not a staff of the organization, but someone that is given the responsibility to handle all their tax activity. So this has to be communicated to the tax authority. Our tax agent is this. So every issue regarding taxes concerning the company, any particular company, tax agent that will be responsible for it. So it's actually not new. The fact that we have consultants in the past, maybe we can say this is a nomenclature thing. The fact that now it has to register, you have to register. And truly, even in the past, for each different tax offices, they actually have the tax representative or the tax consultant of companies actually in their database. They have their details, have been registered. So it's not really new, it's just that, okay, they're now making it more emphatic. Tax agent must be registered authority. Now, let's talk about income from individuals. When Abiola started, he talked about the fact that the jurisdiction, he spoke about the jurisdiction election. And he said there that individual activities are supposed, individual activities are supposed to be collect state internal revenue service and the FCT internal revenue service based on your jurisdiction. When I say jurisdiction, I'm talking of residency. So, and it is expected that the income of individual be filed in the prescribed form with the relevant tax authority in each year of assessment without notice or demand by every taxable person who to pay tax. So you must file that with relevant tax authority. And the return required to be filed shall contain your self-assessment form and the amount of income from every source for the year preceding the year of assessment. So what we mean is that, say in 2026 now, all your activities in 2026 as an individual has to be filed by next year. You will file it and show the details of those revenue, where you earn it from, and activities where the source of the money comes from, so that, and you know this time around, you can't lie. You can't lie because your tax ID is tied to, so if you earn some investment income and you did not report it, it will be obvious, it will come up. Or you have some investment and you are paying, you are taking withholding tax on it. And then the organization is already reporting it that, oh, we are taking withholding tax from this individual. And then you are saying, oh, you don't have that income. It's not going to work. It's not going to work. So what this new tax law will enable government to be able to rake in all those that have been avoiding or evading tax error. So another thing is the pay as you earn. This is the easiest part. Hence that for people that are in employment, their organization as an employer has to deduct on their and remit to the relevant tax. Now, what I think later on, we're going to talk so much about the differences between what it used to be, because this particular law have now repealed the Personal Income Tax Act 2011 that we used to refer to when it comes to pay as you earn. But for now, it is expected that in an organization, it is expected that when an organization deducted tax on behalf of theirs, they remit it, and then before the end of January, by 31st of January of the subsequent year, then they will need to file, and they will need to file with the relevant tax authority. Then it's also the simplified annual tax reform. It is expected that the relevant tax authority may issue guidelines for the filing of a simplified income tax form return by low-income earners or person operating in the formal sector. Now, there is the issue of value-added tax. And as we know, value-added tax is a consumption tax. So it is expected that a taxable person can submit a return to the service in the prescribed form or before the 21st day of the following month. You know, if you have already been complying, we know that this is not new. We all, as organization, when we have taxable activity in the course of the month, and it's month, we file in the manner prescribed by authority. And if you have been doing it with tax pro requirement, you will see that there are particular feeds, the Excel that you need to fill that will help you to be able to file their returns. So now, the new law now introduced the fiscalization system. It started with the large tax. They did a pilot period. They have some pilot period where you can actually interface your billing system. That is, the organization can interface the billing system with that of the NRS, so that the NRS can have a 360-degree view of events, of transactions that are batable, or even at the end of the period, knows those taxes that have been paid, the ones that have not. So where the service deploy an electronic fiscal system, any person making a taxable supply can use the fiscal system for recording and reporting all supplies. The taxable person shall be responsible for maintaining accurate record of all transactions passing through the AFS. Now, this will help the tax authority at the goal to see who is supplying and who is receiving. So the moment they see who is supplying, they know who's supposed to pay value-added tax. And then they also know when the tax is paid, they will know who has paid and who has not paid. So this will really help to rent those services that people are not paying VAT on. Then there's also the issue of surcharge. Taxable person engaged in the provision of relevant services can, in respect of surcharge, submit a return to the service in the form prescribed by the service. So then the other part of it is now this area of virtual assets. Prior to now, people do online businesses, people sell online assets and all this stuff, and they make money, but they are not paying taxes those activities. Now, with this new tax law, there is no space or hiding. Both online, actual, and physical transactions are going to be subject to. So a taxable person engaged in services related to exchange, custody, or management of virtual assets is with or without notice submit to the relevant tax authority so that the relevant tax authority can tax them adequately. So when you make money virtually, you are supposed to pay tax on it. So you make that return and tax authority. Then there's also returns by priority companies. The company granted priority status in each year of assessment file income tax return in the manner specified for both priority and non-priority products or services of the company. So the question is, what makes a product a priority product, or what makes a company a priority company? If the activity or the product that that company is producing is such that we help the government for economic development, you will lead to economic development in a country, or in the country, then we can say that that's priority. So I think that in the future, maybe tomorrow, we're talking about EDI, and maybe we'll talk more about this particular aspect. Then there's also tax incentive returns. Filing incentive return apart from generally the tax filing. Then there's return for deduction of tax at source. It's expected that every person who has an obligation to deduct and remit tax under this act or any other tax legislation shall render monthly returns to the appropriate tax authority. So I will say that this particular law is focusing more on documentation and reporting, because it is when you have the reporting, that's when you yourself, you know that, okay, maybe that's why you're having a lot of challenges as to, this law is going to be a little bit difficult in implementation. The issue is we need to just keep our records, we need to do our reporting, we need to do our filing, and then let's see how it goes. So I think those are the specific returns that according to the law, that we individuals or the corporate organizations need to. But there are information that we have to give to our bankers and other maybe regulated entities and that will have business activities. For example, every bank or insurance company or stockbroking firm or any other financial institution that prepare with or without demand by the relevant tax authority quarterly returns to the relevant tax authority, specifying the names, addresses of new customer and the existing customer. And for existing customer, they must send a return of transaction, cumulative transaction that is 25 million for individual. And for corporate organization, cumulative transaction that is 100 million. So if you are a taxable person and in the course of quarter, you have done that cumulative revenue of 25, or let's say cumulative inflow of 35 million into your account, and for the stockbroker or the insurance company or any other financial institution, maybe Ecofinance House or something, has to report this quarterly with tax authority. So you can see what this will help the tax authority to know is that they will be able to have access to, or so if you are not telling the truth, it will be obvious that you are hiding something, and then they can invite you to explain, give explanation as to, you claim this is how much we had, but we can see that you have done as much as this in this area, Then can you please fill in the gap for us? So most of the thing is that they are going to question us whether we are doing and we are not reporting, or we are not reporting adequately, or reporting in the way that will make it understandable. Now, there is this aspect that there should be a disclosure of tax planning. So any person who enters or intend to enter into any transactional agreement referred to as a disclosable transaction or agreement where principal purpose is a benefit which enables such a person to obtain a tax advantage. Shall provide to the relevant tax authority information relating to that disclosable transaction. Now, what that means is that if there's going to be a transaction that parties are entered into that will lead to maybe an issue of tax savings out of one or the other, that require by this law that the parties or the parties that is going to make that benefit, gain that benefit, it is required to disclose such a transaction relevant tax. Now, what are the things required as enforcement? What are the things that will help the tax authority in the airports as individual or companies in paying or aligning with the requirement? One, we are required to submit returns. Returns is we have a record of what we have done. We have a record of what we have paid based on what we have done, and then you submit it. And if the tax authority is not comfortable with what you have submitted, if they feel that what you have submitted is less than what you ought to, report based on the how do I call it now? The intelligence reports that they will get from all the systems, and ask you to appear in person. So they can invite you. Okay, we have seen what you submitted. Can we look at this together? You can also go there personally to submit the report. So you can still go to the tax office, the relevant tax office, and fill the relevant documentation, date your returns. And you are required to provide books and documents. Now, this requirement always been in the law, but it's just that people do not really take bookkeeping as very important. But this time, we really need to keep our books properly. It's very, very important because you're going to provide those books, you're going to provide those documents to back up what you have submitted as your return. And then the tax authority now, they don't need how do I say it now? They have access. So they have access, so they can easily come to ask you questions, which has also been in existence, to be told. So there's also power to access land, buildings, documents. There's appointment of agent. You can appoint an agent or power of substitution. At least the tax authority can, if they realize that, okay, maybe you are having some transactions and maybe the counterparty that you are having it with offshore, the tax authority can appoint an agent to represent, to be the one to collect on behalf of that offshore company. And the tax authority can audit, and these are audit is required. The investigation can only occur when they realize that you have done something, or maybe there are some actions and they need to understand it better. So these are the requirements in terms of enforcement. Now, what are the timelines for this enforcement? Minimum 7 days notice period for compliance is required. When you meet, if the tax authority says the deadline is so date, and you need to file within that day. They give you a letter, a notice, and the law is saying that minimum days notice period for compliance, for you to comply with the law, is 2 days. And then you can ask for extension. Extension request allowed if you made before expiry of the notice period. So if you are supposed to respond to an issue for maybe 7 days, and you are able to, maybe you still have some information you are gathering and you needed more extension, before the expiration of that notice period, you need to write the tax authority, indicate your concern or request extension. And there must be valid reason for you making this kind of request. Not that you just want to use the data piece to say, okay, let me continue to be writing them. No, you write and give valid reasons why maybe you will not be able to attend those things as required by the law immediately. So the authority will grant you extension in writing. They will grant you the extension in writing. So not verbally, but in writing. So they will respond to the letter you have written that will make it valid. Now, the penalty and interest, nothing has really changed. It's when the tax is not paid when it is due, then it will attract 10% penalty plus interest applicable for late payments. We know that maybe they are still going to bring out circular on this, but interest normally is on the billing interest rate. That's what they normally charge. But we will still wait to see whether the tax authority is going to bring out a circular as to that with regards to what the interest rate. Then NRS can demand for tax due after 30 days non-payment. Expected to pay your tax, you have not paid 30 days. The tax authority is aware, and they will send you a demand notice. You are supposed to pay this particular tax. Now, there is also a provision on the recovery of debts. Any tax due shall constitute a debt, the relevant tax authority, and where the tax due is not paid within 30 days, the relevant tax authority may issue demand notice. They may issue demand notice for the payment of the tax plus penalty and interest. Then there's also assignment of tax debt. So the tax authority could assign outstanding tax debts in owe or tax to an accredited third party who shall assume responsibility for recovery tax. So there is also the power to pay reward. The relevant tax authority may pay a reward to any person in respect of any information which may be of assistance to it in the performance of his duty on such condition, and the quantum of reward as may be by relevant tax authority. The issue of tax refund, this is also another area where people, there is this distrust between taxpayers and government. Everybody in Nigeria believes that whatever goes into government, they come out, then come back. So the issue of tax reform, this law has tried to emphasize that particular thing, that if you pay tax in excess, that you can get a refund, and there is overpayment, you can claim your refund. But just that they have to check indeed that it is okay. So tax authority will make refund any verified overpayment from tax refund. So another thing is the natural single window portal. So NRS can establish a one-step online system for managing all import, export, and trade-related transactions. So the NRS has a capacity now because they are going to be the one to collect on behalf. So those other revenue agencies will do the reporting, will do the assessment. Then FRS with that single window portal, see whether the relevant tax they are on the activities. Then when you need to write a letter to the authority, the law says that all letters must be addressed to the chairman. So documents can be served electronically, or then at the state level, the State Internal Revenue Services, or the state and FCT must establish what they call Internal Revenue Service. So, and we know that all the states have Internal Revenue Service. So when you have to send documents to them, you can send it electronically depending on the capacity of that state, or you can address the letter to, I think, okay. So I think that's what I need to talk about here. But by the time we start dwelling more into the law, we'll be able to talk more and make more emphasis on some of them. Abiola, over to you.
Thank you, Doctor. I think a very good section. All right, so let's move to chapter 3, and that's talking about the general and administrative provisions of the law. And essentially, like I said, this act, the Nigerian Tax Administration Act, is about how you administer the tax system. And it's saying, one, they now allow the tax authority to use digital tools. So tax authority can now leverage on technology to generate data, generate intelligence, and based on that, try to collect additional tax. That is one of the jokers the government should be hoping to use to drive compliance. Since they have banking data, I believe more threshold. Apart from the fact that the bank needs to submit the return, they naturally have that data, so they will be hoping to leverage on that. Tax clearance should be issued once all your tax matters are settled, which is what it is. If you settle all tax issues, they will issue your tax clearance. And the third point is MDA 3 years. Again, this is what happened. The last one is a new one. Tax authority can refund any verified overpayment of tax. So they can refund you. Once they carry out a verification and they are okay, they can refund you. And if they don't refund you within 90 days, they will pay you penalty and interest for not refunding. I hope nobody will ask question of how easy to get the refund, but they can refund it. That's what the law says today. Again, the new law introduced what we call the advanced tax ruling. So you can approach tax authority and say, I want to do, I'm doing this transaction. Please give me your opinion and give me a position. I am not sure what the tax should be. Please give me your opinion, give me your position on respect of that. And that is what the advanced tax ruling is trying to achieve. Tax authority can issue advanced tax ruling for purpose of clarity, consistency within 21 days. If you write to them, I want to do this, please give me your tax opinion or tax position. That's you are obliged or expected to write you back and say, this transaction, this is the tax position, this is what is expected. That is being introduced to again manage dispute between the taxpayer and the tax authority. Because in all sincerity, there are taxpayers that you've done the transaction and you've accounted for it and paid the necessary taxes in all sincerity. But the tax authority then come and say, oh no, your tax liability you paid is not correct. And on top of you possibly trying to pay that short payment, they will stamp you penalty, they will stamp you interest. And you don't want that. So you can go forward to them and they will give you an advance ruling and say, this is our position, which you can hold on to. Well, the government, the president can exempt, subject to approval of National Assembly, can exempt somebody or an industry from paying tax if you find it's appropriate. The last point, all VAT is paid into the VAT pool. I know that this one is doesn't really concern most of us. And this is how the VAT will be shared with the government. Now, federal government takes 50%, state takes 55%, local government takes 33%. That means 35%. And you know, this was one of the biggest controversies around this new law. And sometimes you wonder, all the people making noise about it, are they really politicians? Who does it really benefit of you know? But that's the final agreement. Filing on an appeal on going to court does not stop you from paying tax. If you have an issue and you have decided to head to court, you still need to be paying the appropriate tax to government. So the fact that you are in court does not prevent you from paying tax. All State Board Internal Revenue Service must provide strategic leadership and accountability to ensure that the state meets its revenue objective. Let's talk about the offences and penalties. Now, we've extracted some of the key offences because I think this is one of the areas where there are going to be challenges and where we all need to be careful so that we don't pay unnecessary penalty. So you have the offence and the penalty. Failure to register, 50,000 naira for the first month. If you fail to register and you're supposed to have registered, it's 50,000 naira for the first month and 25,000 naira subsequently. So if you imagine if you've not registered for 3 years, that you're supposed to have registered, 25 times 3 years, 26. That's a tangible amount. Then the next one, award of contract to unregistered person. If you give contract to an unregistered person, 5 million naira penalty. Failure to file returns. If you are supposed to file returns, you did not file. 100,000 naira for the first month and 50,000 naira subsequently, compared to current one, 50,000. So they've increased it. Penalty. Non-maintenance of records, individual or company. You know, a couple of taxpayers like say, no, we don't have record. Again, now it's a punishable offense. If you don't have record of what you have done on transaction as an individual, it's 10,000 naira. For company, 50,000 naira. If you refuse to grant access for deployment of technology, if LRS comes to your office or your location and they want deploy technology. They want to deploy the e-invoicing, for example, and you said no. It's 1 million naira penalty, bam, and subsequently 10,000 naira. If you refuse to process transaction through the fiscalization system, even after deploying, you refuse to use it, it's 200,000 naira plus tax due at interest. If you refuse to use it, penalty for not using it is 200,000 naira plus pay because you were trying to avoid it. You're trying to evade it. They will collect that tax also along with the interest. If you fail to deduct tax as source, at least let's pay attention to this again. If you fail to deduct tax as source, we told tax, administrative penalty of 40% of the amount deducted. So if you're supposed to deduct VAT, we told the tax for my transaction and you did not do it, your penalty is 40% of the amount you're supposed to deduct. 40% of that amount, tax deducted but not remitted. If you deduct tax but you did not remit it, penalty is 40% plus the interest. And the tax you have deducted will need to be remitted to government. Failure to self-account. If you don't self-account for any of those deductions, especially those reverse charges, reverse VAT, all those are reverse VAT. If you don't self-account for it, tax loss self-accounted for will attract a penalty of 10% plus interest. Penalty of 10% and interest, meaning that you did not deduct the VAT you are meant to deduct. If in the course of the work, the tax authority discover that you are contributing to the tax evasion, especially the staff, you will be penalized for maximum of 3 years imprisonment or fine of amount due and penalty of not more than 50% on the sum due. So if they find out that any of the staff possibly is aiding you in evading the tax, in not making necessary returns, they can punish such staff with maximum of 3 years imprisonment or fine of the amount due. You have to pay the amount due plus the penalty can be the obligation. If they ask you questions and you refuse to answer, the penalty will be 100,000 naira at first instance and 10,000 naira per day subsequently. If there are questions asked, you refuse to answer, then your penalty is 100,000 naira at the first instance and 10,000 naira daily / subsequently. Failure to promote documents. Failure to provide document, not promote. Failure to provide document is 200,000 naira at the first instance and 10,000 naira subsequently. If you do not stamp any documents that's supposed to attract stamping, the penalty is 10% of the unpaid duty plus interest. 10% unpaid duty plus interest if you fail to stamp a document. Failure to notify of change of address or cessation of business. The penalty is 100,000 naira at first instance plus 50,000 for each subsequent month. They will help you calculate it and require that send you a bill to pay the penalty. So they will send you letter to pay the indebtedness for the non-notification of NRS for change of address, cessation of business. Forging or illegal removal of stamp duty. If you remove the stamp duty or you forge it, the penalty is imprisonment or 2 million naira or both. Falsification of, collection of bribe or falsification of tax payable. If you help or you support the clients in falsifying the tax payable, 200% or the imprisonment to maximum of 3 years. You pay 200,000%, 200% of the amount or is subject to imprisonment. Giving of bribe, individual penalty under 500,000, corporate 2 million naira. And we're making this penalty strong so that they can deter people from conniving or from evading the tax as much as possible. Impersonation of tax officers. Don't know why somebody wants to impersonate tax officer, but his penalty is 1 million naira. Aiding its commission of offences. You decide to aid the commission of offences, 1 million naira. Obstruction of taxpayer. You do not allow the taxpayer 1 million naira or imprisonment no more than 3. If you make any fictitious claim, what the government will do is that they will recover the amount you have been paid. If you got a fictitious tax refund, they will deduct the amount you've been paid, and 10% of the 100% of this amount are also to be charged as penalty. If there is no specific provision for the offence you have committed, then the penalty will be 1 million naira on imprisonment, not exceeding 3 years. Said in the new tax law, medical insurance is no longer an liable deduction for community. I want to know if staff medical insurance is an liable expense. Well, your HMO staff medical insurance is liable for is an liable expense deduction for your personal income tax computation is still allowed, so it does not change. Determination of residency, these are schedules to the law, and this is talking about foreign employment that for profit from Nigeria or any other income derived from employment in Nigeria by any person not a resident of Nigeria who owns a foreign employment on first January of the year, or who become liable to income tax in Nigeria during the year by reason of employment shall be deemed to be resident for that year. What's the message? You are not resident in Nigeria, so by ordinarily speaking, you possibly should not pay tax because you are working abroad. However, you become liable because you have now made income in Nigeria during the year. You become liable in that year for an assessment. You become liable in that year for an assessment, and you'll be expected to pay income tax on your income you have made in Nigeria. Whether the duties are only performed, if the duties are only performed in the territory which the people of is situated, whether it's performed in Nigeria or abroad, because yes, you are not resident, you have made income in Nigeria in that year, you become taxable and you have to pay income tax in Nigeria in that particular year. The second schedule, which is just for information, is what we call the form of warranty to enter premises offices. And this is just a schedule. What you have there is that those various forms that NRS will need to serve on you when they want to enter into your office. I believe we know that they can come into your office, so they serve you those documents. Warrant of distress. Again, if they want to make distress call to your office, they are calling the police, just like a warrant to arrest. They have this schedule to print and stamp and take through proper process to serve you. They can also serve you warranty of deduction from the student. So the classification of deduction as source now allowing them to deduct part of the tax that is due from your bank account, no, from your allotment. If, for example, is a government parastatal serving on the revenue allocation committee, and they will allow them to deduct all the taxes that you're supposed to pay before even taking you or paying you your allocation for the period. The fifth schedule is on virtual assets, and things that require, let me talk about things. Any taxable person engaged in virtual asset related activities, including exchange, trading, custody, or issuance of virtual assets, or to register with relevant tax authority as a virtual asset with Nigeria Revenue Service, not minding the fact that the basis of you being a virtual asset service provider is you have obtained a license from Security and Exchange Commission to be able to do that you've obtained permission from Security and Exchange Commission before, and Security and Exchange Commission has the regulatory oversight over virtual assets that qualify as security. Please, if you have or you are running any of those platform trading, you are a virtual assets, you have a virtual asset exchange, you have a trading platform, you have a custody, please, you are expected to register with the Security and Exchange, with the Nigeria Revenue Service Authority. Your taxable virtual asset transaction shall include sales, exchange, sell or purchase your crypto, the Bitcoin. All of these are considered as virtual assets, and they will attract appropriate tax. Mining or staking activities that generate income. If you are into data mining and you are generating income from mining the data, you also expect to pay tax in respect of that. Airdrops, bounties, and or any form of virtual asset received as compensation or reward also will attract tax. So if anybody just give you some of these virtual assets as a form of reward, you need to pay relevant tax on this. In determining the value of your virtual asset, it shall be determined based on the prevailing market price at the time of the transaction. Whatever is the market price of that at the time of that transaction, what you need to recognize as the fair value of such assets. The Nigerian Tax Administration Act, I will take the Joint Revenue Tax Board Act now. So in terms of Joint Revenue Board of Nigeria Establishment Act 2025, the Act established the Joint Revenue Board. In part 2 of it, it established the Joint Revenue Board, which is a legal and institutional framework to ensure that there is harmonization and coordination of revenue administration in Nigeria. Coordination and harmonization of all the revenue administration in the country. The local government, the state government, and the federal government are able to work together on issue of tax. And it's also ensured that there is an efficient system for dispute resolution and enforcement of taxpayers' rights, so that whatever issue you have as a taxpayer, it can be dealt with properly. The membership of the board consists of the chairman, who is the chairman, executive chairman of Nigeria Revenue Service. That's the chairman of the board, of the Joint Revenue Board. All chairmen of the State Internal Revenue Service and the Federal Capital Authority are also members. All members of the State Internal Revenue Board are also members. And the board has the power to co-opt any other person, not more than 2. They can bring in additional people. Maybe they feel they need more technical expertise, they can do that. And the service is on a part-time basis. So they are not full-time authority or employment. Part of what the board is supposed to do is to integrate and maintain database of all taxpayers, such that the ultimate goal of having one single tax ID for all taxpayers in Nigeria can be achieved. So they work together to ensure that the taxpayer ID is integrated and is maintained. If there is any dispute between tax authority or residency and other matter, if there is any tax dispute between the state and federal, the Joint Revenue Board will come in to mediate. And they also advise government on double taxation. If they think that something is becoming a double taxation issue, they also do that. So they propose the harmonization of taxes, levies, rates, and charges, and other payment to ensure uniformity. So working together, they ensure that there's uniform harmonization of all of these taxes and levies. The board shall further provide a guidance on the accreditation of tax agents. Again, it is the responsibility of this board to provide guidance on the accreditation of tax agents. What will be the basis of accrediting tax agent, and advise all the tax agents. So I will expect that they will be the one that will even give us the circular for the registration of the tax agents. Let's talk about the tax appeal tribunal, which is also part of what is established. The tax appeal tribunal is set up to adjudicate tax disputes. If you have tax dispute arising from this tax act, you expect that the tax appeal tribunal will be able to handle that. And they are constituted zone by zone, 6 zones, and each is headed by a chairman and appeal commission 3 years. So when there is any tax disputes and you want some form of adjudication, you can go straight to the tax appeal tribunal. My power is of equal status as a high court, or equal jurisdiction as a high court. Then we have the establishment, the office of tax ombudsman. The tax ombudsman is to serve like a mediator. It's like a mediator helping the settling tax complaint. So if you are an aggrieved taxpayer, before you go to appeal, because you know when you go to tax appeal tribunal, it's a legal process to pay tax. Everything is done like lawyer to lawyer. They know all the lawyer technology will be exchanged. But this ombudsman is there to mediate, like a gentleman, between the taxpayer and the tax authority. So you can tell the tax authority or tax officer, this your approach is wrong. It is too much, you know. And you can also tell the taxpayer and say the tax authority have tried, take their position. So that's the purpose of that. So they are not, their decisions or recommendation is not binding on the tax authority, is not binding on the taxpayer, but they advise, they can mediate. Be a citizen of Nigeria and it will be suitably qualified, not less than 10 years of practical experience in the field, is to serve for a period of 4 years in the office. And that is renewed once for an additional 4 years. Provision for the tax ombudsman to have necessary power for the performance, including that they serve as an independent and impartial body to review and resolve complaints. They investigate complaints against tax officers. If you have complaints against tax officers, you can report to them. They will investigate. They were empowered to inspect premises of tax authority, so they can come to the tax office to inspect. It will also institute legal proceedings. They can start a legal process. The office monitors systematic issues and the systemic issues, review fiscal policies, and act as a watchdog. So they can monitor any issues that they identify at the marketplace, and they enter the service without any imposition of fee. So they do not charge. The tax ombudsman will not charge you for anything for providing a service to you. They have some limitation. They cannot interpret tax law. They cannot interpret tax law, and they cannot intervene on any matter that is already before a court or a tribunal, and they can also not determine what the tax liability should be or handle any tax official personal grievances. They cannot tell, oh, this is what it's supposed to be. They can't tell the tax officers that. Thank you. So that's the Nigerian Revenue Service Act. It's a very short one. The small. The chapter 1 is on taxation of income of persons, and says profit or gains or income of a company or enterprise or individual will attract tax. Every profit or gains or income of a company or enterprise or individual will attract tax. And that's the fundamental principle of tax. The tax is on income, is on gains. It should not be on capital. And at every point in time, that is what this law tried to achieve. It's not trying to, okay? So, and your income or profit of a person or enterprise includes gains from a business or trade, income from a profession, dividend, annuities, wins, honoraria, grants, awards, and interest. All of these are potential income sources that will attract tax. And it's similar today. For an individuals, your salaries, your wages, your allowances, compensation, contribution that must be made towards pension, depending on the amount. Then annuity, earnings from annuity will also attract tax. Taxation of residency person. Profit of a Nigerian company are due to accrue in Nigeria, irrespective of where it was brought into or received in Nigeria. A company is resident in Nigeria when you are incorporated in Nigeria. Any company that is incorporated in Nigeria is considered resident in Nigeria. For benefit of maybe those of us that will have some other tax knowledge, in some jurisdictions, it's not about residency. It's not about place of incorporation. It's about physical presence in some countries. In Nigeria, once you are a company registered in Nigeria, you are considered as a resident person, irrespective of where you are generating the income. You are assessed to tax in Nigeria. The second point, if a foreign controlled entity has not distributed profit to its shareholders, the proportion of the profit controlled foreign company attributable to the Nigerian company is included in Nigerian profits. You know that we are in the law proper and the convention is becoming deep. So this point is that I'm Abiola Fajimi, a company. I have another company in Ghana, Abiola Fajimi. The Ghana business has refused, they didn't pay me, they didn't distribute any profit for the year, but they made profits. When you get to Nigeria, the tax authority will do a proportional share of your profits that are supposed to belong to the Nigerian entity if it's not fully owned. And whatever is your own share of that profit will be assessed to tax in Nigeria. You'll be taxed based on that. That's important for those of us that will possibly have foreign subsidiaries. If you are a foreign subsidiary of a Nigerian company or a member of a multinational group in a year, pays less than minimum effective tax rate of 15%, Nigerian company shall be paid the difference to the enterprise multinational to the effective minimum tax rates. What this says essentially is, if you are considered to be a multinational group, you belong to a multinational group, you are operating in Ghana, you're operating in Zimbabwe and all over the place. If at the end of the day, your effective tax rate is less than 15%, what is your effective tax rate? Your effective tax rate is your tax payment over your profits, your tax payment over your company, your profit, your CIT and your development levy over your profit. If it's less than 15%, then you need to increase or pay additional tax to bring it to 50%. This is a new provision, and I think for multinationals, this may be a major impact, such that no matter the tax planning you do, if the tax you are paying to government, by the time they add your CIT and your development levy is less than 15% of your profit, you would need to pay differential to the government, because you must have a minimum effective tax rate of 15%. So you cannot overplan. And no matter how good is your tax planning, you will still pay a minimum of 15% to government. Substitution of dividend for profits. When profits is declared out of profit which no tax has been payable to, due to there being no tax profit or tax profit less than dividend declared, the dividend shall be substituted for to tax profit. This is a case of, okay, so this year you are paying dividend out to your shareholders, but when you look at your taxable profits, maybe it's zero, so you are not even paying any tax, or your taxable profit is less than your dividend, the total dividend you are paying out. In that case, the tax authority will take the total dividend you are paying out as your taxable profit, and the tax will be computed based on the dividend. And the dividend must be from profit that has not been previously taxed. If the profit has not been previously taxed, how will you manage that? So if you look at your retained earnings, since dividend is paid out of it, you need to determine the amount of the retained profit you have that has been previously subjected to tax. You need to look at the amount of the retained earnings you have that have been previously subjected to tax. So if last year your retained earning closing was, let's assume for just for analysis, 10 million naira, the additional retained earning for the year is 60 million, and you decide to now pay a dividend of 40 million. And in this year that you have a retained earning of 60 million, you do not have a taxable profit, or you have a taxable profit that is less than the dividend you are paying of 40 million. What the tax authority will do is to take your 40 million as your new taxable profit, and it's on that 40 million that they will be computing your CIT and your development levy. Again, this is actually not a new provision of the law. It's just that it's one of those unpopular provisions of the law. Yes, this first one really will affect mainly big institutions that pay dividend regularly. But when you think about the private companies that don't pay dividend, pay attention here. When a Nigerian company that is controlled by not more than 5 individuals has not distributed profit to its shareholders as dividend, profit made in any period may be construed, the service may construe the portion of the profit not distributed as profit distributed. We all know what happens in a lot of private companies. You don't pay dividend. The dividend is just kept there. But somehow, the owners of the companies are happy, and their needs are met, and they are not worried. So they continue to keep everything as retained profit. They just continue to keep that. This laws is about to change that now, because he's saying that if your shareholders are not more than 5, they are just 5 individuals that control this entity, they can decide that the profits that you have not distributed, since you refuse to distribute the profit as dividend, so that they will not tax you based on dividend, that the profit you have not distributed becomes the taxable income. They will construe it as your taxable income, and based on that, they are going to be using it as dividend paid, and that will be used as the basis of computing the company income tax for you as an organization. Let's talk about individuals. Incomes, gains, or profit of an individual resident in Nigeria are deemed to accrue or chargeable to tax in Nigeria when they arise or brought into Nigeria. As far as you are resident in Nigeria, whatever income, gains, or profit you've made as an individual is deemed to have accrued or is chargeable to tax in Nigeria. You are subject to tax on it, whether you made it in Nigeria or you made it abroad. Let's talk about benefit in kind. Benefit in kind is now very sensitive, and it will impact on a lot of us really if they decide to enforce it to the latter. When the asset of a company is used by an employee, the employee is assumed to have earned benefit on an amount equal to 5% of the value of that asset. If you are using the asset of a company, you are using the car of the company, it is assumed that you've earned benefit that is equivalent to 5% of the value of that asset, and that 5% will be added to your taxable income, except for canteen meal, that is specifically excluded if the company is providing you lunch or meal at work. But if you have an official car that you're using, 5% of the value of that asset is expected to be added to your compensation, your taxable income, and appropriate tax will be paid on this. A major shift is that for the taxpayers. Where the employer provides employee premises and the employee does not pay rent or pay an amount less than the market value, if you give your staff official apartments, they have residential apartments that they live in, then employee is being treated as being receipt of additional emoluments. It is considered as if you are paying them extra income, and the rental value of the premise, but not more than 20% of the annual emolument, will be added to the salary of the employees. So whatever is the rental value of that apartment you have provided, not more than 20% of the total emolument will be added to the income of the employee. Again, if you are an organization that gives personnel accommodation, they have official apartments, this may impact on you, because what they will do, what is expected to happen is that whatever is the value of the apartment that you've given to your employees or the staff are being provided with, the rental value is added to the total emolument of such personnel, not more than 20%. So you work it out, be sure that not more than 20% is added to arrive at the taxable, or to arrive at the total income of such personnel that will be subjected to tax. So that element will now be taxed going forward. Two things that have been mentioned: the car, the company assets, and the premises. This is the new tax rate, the new tax table. And part of what has also happened is that all the consolidated of those days are gone. We no longer have those consolidated relief and co. They are gone. We just have rent relief allowance. And your rent relief allowance is lower of 500,000 or 20% of annual rent paid. Lower of 500,000 or 20% of annual rent paid, which means the maximum amount you can claim is 500,000. If you pay a rent of 5 million, for example, 20% is 1 million. You cannot claim 1 million because you can only claim the lower of the two. So that is one of the things you are allowed to deduct against your taxable income. So in arriving at this table, just illustrate how the calculation is done. We will talk through this tomorrow. We'll walk through a calculation and example. I will bring the templates that we also can find useful as organization. Irrespective of how you break down the headers, some of us are specialists in breaking down income, basic housing, transport, but the taxman cares less today. Whatever is your total annual income, when you aggregate all the income you've made, everything added together, becomes your gross annual income. Then you will deduct National Housing Fund contribution. If out of the staff salary, out of the income or the gross emolument, you are paying National Housing Fund contribution, that will be deducted from the gross. The National Health Insurance contribution, NHIS, will be deducted from the total salary. Pension, if you are a pension made, that will also be deducted. If you have interest on loans, owner occupied house, if you've borrowed money to build a house previously and you are living in the house, whatever is the interest on such loan will be deducted. Life insurance premium, if you paid life insurance premium, it will also be deducted. Then annual rent, the lower of 500,000 or 22 or 20% of your rent will also be deducted from your gross annual income to arrive at your taxable income. And whatever is this taxable income is now subject to tax using the tables below. The first 800,000 of that taxable income will attract 0%, no tax on it. The next 2.2 million will attract 15%. The next 9 million will attract 18%. The next 25 million will attract 23%. And anything above 50 million will attract 25%. Which means before you can actually start having rates at 25%, you will have passed an income band of 800,000 plus 2.2, that's 3 million, plus 9 million, that's 12 million, plus 25. 12 plus 25, that's 37 billion. So it's when your income, total income, passes 27 million. In fact, no, that's not correct. 800, 312, 12 plus 25 is 23 billion. So that's when you get to 37 billion that you can now start attracting a higher rate of 25%. So we use the rate to multiply the amount to arrive at what will be the tax payable. And one more point I want to mention in respect of this personal income tax, and we also need to start working on this quickly, because you know our annual individual tax filing, personal income tax filing is 31st January. So we need to quickly go and start amending our payroll structure because of our projection. You know, when you file those your annual returns, we always put in projection for the year. We need to quickly start looking at our employees' tax table. Tomorrow when we come, we will possibly bring a template. That's why I want us to stop here and discuss it tomorrow. So we need to start aligning our payroll and recompute what the tax is likely to be for next year. Remember, it's already effective, and so when you are paying January payroll, you are the right thing would be to be paying based on the new arrangements, the tax and the deductions. And one of the key changes that is introduced is the fact that individual needs to now file annual returns. Remember, before it's only employer that used to file. You will file as the employer files for all of us. Going forward this year, I'm not sure whether they'll be able to achieve that yet, depending on how ready they are. Individuals will also file. So as Abiola Fajimi, beyond what PML Professional Services has filed, I'm expected to go into e-tax in Lagos State and also file my own return, declaring my own income myself, that this is what actually happened. I say PML Professional Services, this is what I generated from it, this is how much tax they said they paid on my behalf. My side also, this is how much I made, and this is what I think the tax should be on it. So there is now individual self-returns filing that must happen as part of the annual filings. Yes, we will share the recording, don't worry. We will share the link for the recording, the link to the recording to everybody. All right. I think there are no other questions. I'd like to thank everybody. I'd like to thank Major Odeyemi that will facilitate this section together. I'd like to also thank Adeola Adesoya. Thank you for your time, and every of us that have taken part of our body to be part of this section. Thank you very much, and remain blessed. See you tomorrow, 9 o'clock. Thank you.